You can experiment with your investments. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
How can a person tell the difference between a healthy and unhealthy investment portfolio? Naturally, it's by how well or poorly a portfolio does at addressing crucial areas like taxes, like cost, like diversification, risk, and performance. Here's the problem. Poorly constructed portfolios are usually ignorant about the first four things, which explains why unsatisfactory performance results typically follow. Now, my latest portfolio report card is for PLR in Medley, Florida. This is a vibrant married couple. They're in their early 60s. He's still working and she's retired. PLR has a financial advisor, but they recently became concerned about both the cost and investment choices being made within their investment portfolio. PLR asked me to analyze and grade their combined portfolios to identify strengths and weaknesses of their $863,309 investment plan. After a brief initial chat, PLR told me that they're still in the accumulation phase of their investment plan and that they intend to hold off on taking any retirement distributions from this money, and they also intend to hold off on accessing Social Security until they reach full retirement age. They also told me, quote, "We want to protect what we have accumulated and only pull out 3% out of our portfolio every year starting in 2018. PLR's combined portfolios consist of 2 traditional IRAs, 2 Roth IRAs, and a joint taxable account. PLR owns 17 mutual funds and 7 ETFs. It's worth mentioning that PLR told me that they expect to receive a very poor portfolio report card grade of D or F. Now the question is, will they be able to beat their own depressed expectations? Let's do a portfolio report card and find out. The first grading category is cost. A portfolio with excessive investment cost does not need a bad year to underperform, and that's why it's so crucial to minimize investment expenses to the greatest degree possible. This means cutting your mutual fund expenses. It also means minimizing or limiting brokerage commissions and other frictional costs. The average expense ratio for PLR's mutual fund and ETF holdings is 0.91%. And if we add another 1% for the annual advisor fee that they're paying, their total expenses approach 2% annually. Ouch! Now, although PLR's portfolio does own a few low-cost ETFs like ticker symbol BND and XLV and XLB, the bulk of their money is still invested in higher cost funds, and that's a problem. Next up is diversification. So what is authentic diversification? Well, it's all about exposure to all the major asset classes, including stocks, bonds, commodities, real estate, and cash. PLR's combined IRAs and taxable account do have exposure to U.S. and foreign stocks. That's good. Also bonds and cash, also excellent. However, the combined portfolios miss exposure to some major asset classes, including global real estate, as well as commodities, and for bonds they lack exposure to foreign bonds. Also, they do own some multi-asset class funds which hold a mix of different types of assets like stocks and bonds in the same portfolio. And the problem with that is it kind of complicates their overall asset allocation because managers are constantly increasing or decreasing exposure to all these various asset classes at will, and it creates a lot of unnecessary complication when it comes to diversification. The next grading category is risk. Now, the risk character of a portfolio should always be 100% compatible with the risk profile of the person. PLR told me that they're neither aggressive nor conservative, but somewhere in the middle. We call that moderate investing. or moderate investors. PLR's IRA, that's hers, holds 68% stocks, 23% bonds, and 8.2% of multi-asset class funds. His IRA holds around 52% stocks, 25% bonds, and 22% to multi-asset class funds. This asset mix closely matches moderate investors in their early 60s. Nevertheless, a 20 to 40% stock market correction would subject this portfolio mix, as it is right now, to potential losses of $100,000 to $200,000. Moreover, since the bulk of the combined portfolios are in actively managed funds, the inability of fund managers to beat their benchmark is another element of risk. The next grading category is tax efficiency. What does that mean? Well, it's all about minimizing the negative impact of taxes by owning or investing in tax-efficient vehicles like index ETFs. That's one way. It's also accomplished through smart asset location. Avoiding premature retirement plan distributions and 401k loans are other tax-smart moves. Now, I observed no tax efficiency problems with PLR's combined portfolios, so very well done. Last up is the final grading category, which is performance. Your performance return will always do one of two things. Number one, it'll validate the portfolio's design, or number two, it will incriminate it. And that's how it works. And when a person's portfolio cannot keep up or outperform a blended index benchmark that corresponds to their same asset mix, well, then we've got problems, don't we? So how did PLR do? PLR's combined portfolios had a one-year gain of $10,496, or 1.7%, from end of December 2013 to the end of December 2014, versus a 5.23% gain for a blended index benchmark matching their asset mix. Put another way, PLR underperformed by 3.5%, and that's unsatisfactory. The final portfolio report card for PLR is a C. Now, this means this portfolio that PLR has put together has meaningful structural weaknesses. The biggest problem areas are obviously subpar performance, but also investment cost, which is way too high. In each of these subgraded categories, PLR's portfolio flunked. Paying almost 2% in annual fees on an $863,000 portfolio is around $17,000 annually, and that's far too much money to be forfeiting every year. Also, it's surprising to see that this particular financial advisor helping PLR their portfolio is under-diversified and misses exposure to some major asset classes like real estate and commodities. Clearly, this particular advisor is not earning their keep. In summary, I know that if PLR fixes the weaknesses that we identified inside their portfolio, they can and will get a better grade in the future, and more importantly, they can put their investments back on track and reach their goals. How is your investment portfolio doing? Go to PortfolioReportCard.com to find out.